The paper price just got smashed again, and they want you to think the move is over. But here's what actually happened. While the screen price dipped, the physical market didn't crash, it got tighter. The spread between what silver is trading for on paper and what real buyers are paying in the real world is flashing the same warning signal over and over. And if you understand that one detail, you'll understand why $300 silver is not a meme, it's a math problem. Welcome back to Silver and Golden Signal Lab. I'm John A.G., and today we're breaking down the exact chain reaction that can take silver from volatile to vertical, and why the next shock won't be a small spike, it'll be a structural reset. Before we dive in, quick announcement. We're doing a silver giveaway, 20 ounces, no complicated hoops. To enter, hit like, subscribe, and drop a comment with either your favorite type of silver to stack or your silver price prediction for 2026. That's it. Like, subscribe, comment, and you're in. Winner gets announced at the end of the month on a live stream. Now, let's talk about the lie. The lie is that the price is the truth. In silver, the price you see is often the most manipulated, most paper-heavy representation of reality that exists in any commodity on Earth. It's not a pure supply and demand number, it's a casino chip number. And the reason I'm starting with that is simple. Because every person who gets shaken out by the same weapon, volatility. Up $7, down $3, up again, smacked again. They want your emotions on a leash. They want you reacting to candles instead of thinking in cycles. So the question is not, why did silver drop today? The question is, what happens when the world stops accepting paper claims and starts demanding metal? Because that is the direction we're moving, fast. You can feel it in every part of the supply chain. Dealers don't talk like they talked 5 years ago. Refiners don't talk like they talked 5 years ago. Mints don't act like they acted 5 years ago. And big buyers, the ones who move shipping containers, they are not waiting for the mainstream media to approve the trade. They're doing something much more dangerous to the system. They're quietly taking the metal. And that leads to the real story most people missed. The physical pricing pressure outside the Western paper exchanges is growing teeth. When you see one region paying a strong premium for real silver while another region prints a lower paper price, that's not random. That is a signal that the market is splitting into two worlds. World 1 is paper, World 2 is physical. And the moment World 2 becomes big enough, World 1 can't fake the number anymore. Think of it like this. If there's a store selling water for $1 and another store across the street selling the exact same water for $14, where do the trucks go? They don't go to the $1 store, they go to the $14 store. Silver is no different. If Asia is willing to pay up because they're actually taking delivery and using metal in industry, then physical flows migrate. You don't even need a conspiracy. You just need profit incentives. And as those flows migrate, what happens to the vaults that are backing the paper game? They drain, slowly at first, then all at once. This is why the system keeps repeating the same old tricks. Margin hikes, algorithm dumps, fake fear headlines, end of rally narratives. Because they don't have new weapons. They only have shock tactics. The problem is, those weapons don't work the way they used to. 5 or 10 years ago, they could smash the price and it would stay smashed. Today, they smash it and they get flooded by physical demand. The dip doesn't stop the buying. It accelerates it. And that is the nightmare scenario for a paper-driven exchange. Because a paper exchange survives on one illusion. Most people will never ask for the metal. But what happens when people do ask? You already know the answer. They can't deliver what doesn't exist. And this is where things get spicy. Because if you've been watching carefully, you've probably noticed something weird. The paper price can drop, but real-world availability doesn't suddenly improve. In fact, sometimes it gets worse. You see spot drop, and premiums stay high. You see spot drop, and items go out of stock. You see spot drop, and shipping times stretch. That tells you the drop wasn't a supply increase. It was a paper event. And paper events are temporary. Physical shortages are permanent until price forces change. Now, let's talk about this scenario that makes $300 silver possible. Because I want you thinking clearly here, not emotionally. A $300 silver move is not built from hype. It's built from a chain reaction. And chain reactions start with pressure. Pressure comes from mismatches. Mismatches come from one thing: too many claims, not enough metal. And the closer we get to a delivery crunch, the more violent the reset becomes. So what could trigger that crunch? 3 catalysts. Catalyst 1, the delivery month stress test. There are certain windows in the year where physical demand and contract settlements stack up. When that happens, the paper system either proves it can deliver or it proves it can delay. Delays create panic. Panic creates more demand. More demand creates bigger delays. That's your loop. Catalyst 2, the spread becomes impossible to ignore. If physical markets keep trading meaningfully higher than paper markets, arbitrage traders smell blood in the water. They buy the cheap side and sell the expensive side, but to do that in size, they need inventory. And if the cheap side is backed by fragile vaults, they pull the metal out. Catalyst 3, a geopolitical or financial shock that flips psychology. This one is the wild card, and it's the one most people underestimate. Because the world is not calm right now. It's not stable. Every week there's another flashpoint, another sanction, another shipping disruption, another energy squeeze, another banking headline. And one morning, it won't be news. It'll be your ATM not working. And on that morning, you won't care about the daily chart. You'll care about whether you prepared. That's why people stack. Not because they want to win a trade, because they want to survive a system failure. And here's the truth. Even if the system doesn't collapse tomorrow, silver still wins. Because the industrial side is tightening the market regardless. Solar keeps absorbing metal. Electronics keep absorbing metal. Grid upgrades keep absorbing metal. Data centers keep absorbing metal. And now the world is racing into resource-intensive everything. Electric vehicles, charging infrastructure, military tech, medical tech, AI hardware, nuclear buildouts. All of it eats metals. And silver is the most underestimated of the bunch because it sits in this weird identity crisis. It's treated like a shiny collectible, while it's being consumed like an energy material. That contradiction doesn't last forever. The market eventually resolves it. Now, let's zoom into the default conversation, because people throw that word around loosely. A default in this context doesn't have to look like a dramatic headline with sirens. It can look like something far more subtle. A technical glitch, a settlement delay, a contract change, a cash payout instead of bars, a temporary rule adjustment, a force majeure event. All of those are soft default behaviors, because the moment an exchange proves it can't consistently deliver metal at the promised terms, the world loses confidence in the paper contract. And once confidence cracks, paper volume becomes a liability instead of a shield. Now, I want you to picture the moment this shifts from interesting to historic. It starts with one headline that looks boring to most people. Something like, exchange announces new settlement options. Or temporary changes to delivery procedures. Or unexpected surge in demand. Most people will scroll past it, but you will know what it really means. It means somebody asked for metal, and the system felt pain. Because the paper system is built on a simple assumption. Contracts can be netted, rolled, delayed, and offset forever. But physical demand is a different animal. Physical demand is binary. Either you have the bar, or you don't. And when the world begins demanding bars, every paper trick becomes a countdown timer. This is why the margin hike tactic is such a giveaway. When an exchange raises margin, it's not because they suddenly care about your safety. It's because they want to force weak hands out. They want to shake out the leveraged longs. They want the price down fast, so headlines can scream, "See, bubble popped." But if the metal is scarce, all they are doing is throwing gasoline on a fire. Because the long-term buyers don't get scared. They get hungry. They see a discount, they place bigger orders, they take more inventory. And every ounce removed from the system makes the next smash less effective. That's the doom loop for manipulation. The more you smash, the more you drain. The more you drain, the more fragile you become. The more fragile you become, the more you need to smash. Until one day, you smash, and it doesn't bounce back. It gaps higher. And that is when the market changes character. You don't get slow climbs anymore. You get air pockets, you get repricing, you get a new world. So here's the cliffhanger you should keep in your mind when you look at the chart this week. Are we watching a normal pullback inside a bull market? Or are we watching the last calm moment before the physical market forces a reset? Because those two outcomes look identical right up until the instant they don't. And when the switch flips, the people who waited for confirmation will be buying after the move. The people who stacked it during boredom will be holding the position everyone else wishes they had. So what happens if the paper system breaks? The price doesn't go up $10. It reprices into the nearest physical truth, meaning the benchmark moves toward where the real market is clearing. And that's why a huge spread matters. Because a wide spread is a preview. It's the future leaking into the present. If you want to know where silver can go in a hurry, don't stare at paper charts all day. Watch physical pressure, watch premiums, watch availability, watch delivery delays, watch what big buyers are doing, because that's the real scoreboard. Now, I want to give you the part that people always skip, the strategy, because knowledge without a plan is just entertainment. Here's the game plan if you believe silver is entering a structural squeeze. Number one, stop trying to time the perfect dip. You are not competing against retail buyers. You're competing against industry, and industry doesn't care about your Fibonacci line. They care about securing supply. That's why the most powerful strategy for normal people is boring. Dollar cost average. Stack consistently. Stack calmly. Stack when it's up. Stack when it's down. because the goal is to build inventory before the inventory disappears. Number 2, choose weight over gimmicks. There's nothing wrong with collectible coins if you love them. But in a true shortage, the world pays for atoms, not art. Bars, recognizable bullion, common sovereign coins. That's what stays liquid and easy. The less premium you pay today, the more ounces you control tomorrow. And ounces are leverage. Number 3, diversify your exposure. Some people only want physical, and that's fine. But there's another layer to this. Miners. Miners are leverage to the metal. If silver goes from 90 to 150, a well-run miner doesn't move 17x. It can move 5x, 10x, 20x. But here's the trap. Not all miners benefit equally. The two things you watch like a hawk are cost structure and hedging. If a company locked in future production at low prices, they don't fully benefit. You want clean exposure. You want companies that rise with the spot price. You also want safe jurisdictions when possible, because when metals become strategic, governments get creative. We've seen it before. Taxes, royalties, permit freezes, nationalization rumors. When the prize gets big enough, the game gets political. So you don't just buy a ticker, you buy a jurisdiction. And number 4, understand the timeline. Silver doesn't need everyone to wake up at the same time. It needs one big buyer to panic first. That's how squeezes start. One large industrial order, one big sovereign shift. One major vault drain, one delivery surprise. Then the headlines follow, then the crowd follows. And when the crowd follows, the price doesn't politely climb. It gaps, it spikes, it shocks. And that brings us to the $300 number. How does silver get there? Not by slow growth, by revaluation. If the market finally admits that paper supply is not real supply, it has to price silver high enough to do 2 things at once. Pull metal out of hiding and ration demand. That means the price must become painful. Because a painless silver price does not solve a shortage. A painful price is the mechanism. $300 doesn't even mean silver is rich. So here's the question you need to ask yourself, and I want you to answer this in the comments. Do you think the paper market can hold control through the next major delivery stress test? Or do you think we're about to see the first real crack? Second question, because I'm genuinely curious. If silver hit $300, would you sell immediately? Or would you wait for the next phase where gold and other hard assets get repriced too? Drop your answer down below. Now, let's talk about why 2026 could be the most chaotic year for the financial system in a long time, even if you never get a central bank collapse headline. Central banks don't just disappear. They evolve. They tighten control. They adjust rules. They change settlement methods. They add new digital rails. And they do it while telling you everything is fine. But the reality is, debt-based systems eventually run into the same wall. You can't print resources. You can print currency. You can print credit. You can print promises. But you cannot print copper. You cannot print silver. You cannot print uranium. You cannot print oil. And the world is waking up to that reality right now. That's why strategic minerals are becoming the real battleground. Most people only think about gold and silver. But behind the scenes, nations are fighting over a long list of inputs that modern life depends on. And here's the scary part. Most people don't notice a mineral until it's missing. They don't notice it in their jacket. They don't notice it in their cookware. They don't notice it in their phones. They notice it when production stops. And the moment production stops, the price doesn't creep up. It explodes. That's why I keep hammering one theme. Preparation beats prediction. You don't need perfect timing. You need positioning. And that positioning is simple. Build real assets, reduce fragile risk, hold what survives chaos. Now, I need to say something that might sound dramatic, but it's true. The people who win this cycle will not be the people who watch the chart the most. It will be the people who stayed consistent while everyone else got distracted. Every cycle has a psychological trap. In metals, the trap is boredom, months of nothing, weeks of chop, fake dumps, fake rallies. It's designed to wear you down. Then, when the real move begins, you're exhausted and underpositioned. So don't play that game. If you're stacking, stack with a plan. Set a schedule. Stick to it. Ignore the noise. And when the market tries to scare you, remember, a dip is only dangerous if you're over-leveraged. If you're stacking physical with a long-term view, dips are gifts. Now, before we close, I want to say this clearly because it matters. If you're part of the movement against copycats, comment John A.G. Best so I can see you. And don't forget, subscribe to support the original work because we're putting out content every single day and we're building the most locked-in stacking community on this platform. The giveaway is live. Like, subscribe, comment your favorite silver, or your 2026 price prediction, and you're entered to win 20 ounces. And here's my final warning for you as we head into the next phase. When silver starts moving for real, it won't feel comfortable. It will feel violent. There will be limit up days. There will be sudden dumps. There will be headlines designed to confuse you. There will be experts telling you it's over right before it begins. Your job is not to predict every candle. Your job is to hold your strategy through the storm, because when the paper game breaks, the metal doesn't ask permission, it revalues. And if you're positioned before the crowd understands what's happening, you're not chasing, you're leading. Take care of yourselves, take care of each other, and I will see you in the next video soon.